Welcome to the daily update. This is Being Prepared Thursday, October 6th, where we'll look at the action in the market today and then see how things look for Friday, October 7th. And just a couple of housekeeping notes before I get going. I am attending an online conference this weekend put on by stockcharts.com. And because of the time difference of where this conference is taking place and where I'm living, that means I'm going to be awake most of the night and trying to sleep during the day in my current time zone. So that could mess with my posting a little bit. I try to be consistent, at least Monday through Friday with the postings, but because of the weekend, sometimes that varies quite a bit. Well, it could vary even a little more. I don't know if this is going to help my posting schedule or actually delay it a little bit, but I will get things posted for the weekly video and the intermarket analysis video, as well as the daily video for Monday, just as soon as possible. All right, let's go back and talk about what happened. We're still pulling back right now. We're kind of in a mixed environment technically. We're negative with our technicals, but there are some pockets of hope. There are some potential positive setups that we can look at. We have a big report coming out before the market opens on Friday, and that's the employment situation report. And that's what a lot of folks have been using to justify that maybe we're not in a recession because the employment situation is still pretty positive and growing. And even Chair Powell has said, well, as long as employment is strong, we really are going to maintain this more hawkish stance. Well, this could have a real influence. If it comes in weaker than expected, that might give the market some support. If it comes in stronger than expected or kind of in line with what they're expecting, we might not really have all that much decided. So we'll just have to see. And also, while I'm thinking about it, I hope that the Seattle Mariners do a good job in their first game in Toronto in the wild card playoff. So there. All right. So at the open, we did have a lower open, and then we saw some selling kind of feeding into that right after the open. We fell below the daily pivot at 37.71. We went down to 37.50. That wasn't a pivot level. It wasn't a support or resistance. It would be support in this case. It was just a round number. There's a lot of option activity probably at that level. It's a psychological level. Well, we found some support at that point, and prices tried to rebound as we went forward, but remained negative. We never did really get to a point of going positive. Going into the close, prices then drifted lower, but didn't even get down to S1 at 37.35. So we didn't hit that level in today's session, but we did close near the low. We were down 1.02% overall. So we're working off a lot of this overbought condition. We're still dealing with some of the oversold condition, and we're kind of in a mixed environment right now as far as do we look at it half full or half empty. And there's a case for either side right now, and I'll try to go through and point that out. We're still seeing volume right at average, just a little bit above average right now. So these last couple of days, as we've been pulling back, it's like folks are getting ready for the other shoe to drop. Well, is that going to happen in Friday's session, or is anything at all even going to be decided on Friday? The technicals, they're still negative overall. We're not really showing much improvement there. We're not seeing any price confirmation by things going higher, but there's also some positive things that we can look at and say, okay, if we see price moving higher, this confirms some of the positive signals that we're seeing. If we end up going lower, well, we're already in a technically negative environment anyway, and that would confirm prices actually going lower because of the inflation and interest rates, which are producing growth concerns, which is having a real impact on the economy. All of the other things that are listed here, they could come to the forefront. There was some Fed speak that I'll deal with just kind of on a high level basis because they're saying the same things that they were saying before. Rising interest rates, that's what really affected prices in Thursday's session, and the stronger dollar. The dollar was going up, interest rates were going up, and that provided a lot of pressure to stocks for them to actually move higher because we're seeing them tend to go in opposite directions. If interest rates are going up and the dollar is going up, stocks are having a tendency to go down, and vice versa. And then this inflation has topped, and so will the Fed. That's still floating around out there. But on Thursday, they kind of stepped back and went, well, maybe we're not going to go with that scenario as strong as we were just a couple of days ago. But if we come roaring back, and if we have a really good day on Friday, this is what you'll hear about over the weekend. The Fed speak that we did hear, it still remains hawkish. They're not pivoting. Nor Chair Powell is not pivoting. Haven't heard anything from him. But the other folks that are giving speeches or interviews or just talking right now, they're not changing their tune. They still are sticking to this idea that we want to get inflation under control. And if we need to keep raising interest rates, even to the point of pain, we're going to still do that. Oil is rising still because OPEC has said they're going to be limiting their supply starting in November. This was a point from yesterday's video. I just wanted to bring it up again because it's still having a flow through, no pun intended, influence on the price of oil, and will probably have an influence on the price of gas right before an election. And so this is really making a lot of the politicians rather nervous. Also, in the last couple of videos, if you've noticed my voice, I've been coughing and hacking a little more. It seems like could be developing into something. So I ask for forgiveness before I cough and hack. Now watch, I'll get through this video just fine. The 30 to the 5, the 10 to the 2, the 10 to the 5, they're still inverted. Sentiment is still fearful. We ticked down just a little bit, but we're not extreme right now. And then if we get some kind of a strong bounce up out of this, not necessarily in Friday's session, but if we see things really start to move to the upside with a few days in a row, you might have the fear of missing out starting to kick in, because there is a lot of, as I'll show you, there's a lot of cash on the sidelines. And if people are in their money markets just waiting to do something and they see things start to turn more positive, it's very likely that they might jump in. Number one, that could be positive because it could give some more support to stocks since a lot of folks are really heavy in cash. But at the same time, these folks that tend to react to what's already happened, they tend to come either late to the party or when the party's already over. And we really want to see where we're at if that happens, because that might be some resistance that we run into and then things turn and go down. We've seen that happen a lot in 2022. We just want to be aware of that going forward. We had jobless claims. That was the only report that came out, and they were at 219,000. They expected it to be at 203,000. Okay, so for the first time in a while, we're seeing more jobless claims coming out than what they were expecting. The usual trend over the last number of weeks has been the number has been lower than what they expected. Our trend is negative and weakening, and we've dropped below the moving average. So if you use the ADX a little more aggressively, you might think that we're in a trendless environment right now. But if you're more conservative, we're not below 20 yet. The bias, I've switched back over to negative because of the down day. I'm still keeping momentum at mixed because we're kind of at this tipping point. We had Monday and Tuesday were really strong. Wednesday, a little bit of a pullback. Thursday, a little stronger pullback. Let's see if something can get decided on Friday, but we don't really know what that's going to be. You can make a case for either side. So let's go back and look at the session. We're at 28 right now, right on the edge of the fear category, but we're not in the extreme camp. You can see how it's coming down again with these 2 down days that we've had. This next chart is an Isabel Net chart, and this is pretty much just the same chart that I've been showing in my videos. What I was really watching for was this green line, and that's the 200-week moving average. This is a weekly chart here, and as of last Friday, we came right down to this point, and we've been bouncing up since. Now, this is a weekly bar, so you're only going to get 1 bar in here, and this might be a few days old, but this overhead resistance that you see on this, that's some of the resistance that I've been pointing out. And if we break above that, of course, there's additional resistance as well. So this chart is pretty much just confirming what we've already been seeing. But it's also another reason why watching the daily videos can really benefit you, because I talked about this a number of days ago. I first covered it in the weekly video, and then I've been covering it in the daily videos all week. So I'm not trying to toot my own horn or anything, but it just pays to keep up with things as they're happening, to develop this forward-looking scenario that you can work through. All right, another one. This is also showing this light blue line. This is money markets and how a lot of people are in cash right now. That's what people set up at brokerage accounts. When you don't know what to do, you park your funds into a money market before you deploy it. And now I have to clear my throat. Okay. So if we really, and most people want to buy low and sell high, they go long in the market. So if we do start to go up, you could potentially see this light blue line come down as people try to chase returns. Then we have equities over here in second place. Government bonds is the orange line. And then we're seeing the corporate bonds. Even though some folks really enjoy investing in corporate bonds, their rates are going up, but they don't get a lot of the press that the treasury bonds do. There's another one, Ntm Next 12 months. Now, when I do the weekly video, I show how are we looking with the valuation, and I use the TTM, trailing 12 months. I'm looking backwards to see historically where are we at. The NTM looks forward, and looking back, we're still overvalued. We're below a PE ratio of 20 right now, but we're not in the 15 area. And that's because we've been coming down. So you could make a case that we're more fairly valued right now. But when you look forward at the PE ratio, we're right at about 16. And this could be a few days old right now. And 15 is considered to be fairly valued. So with all of these EPS adjustments that are being made and the fact that the S&P has been coming down, this could be positive for the stock market. They're considering it not to be too expensive at this point. Then we also are showing a reaction again with the RIDEX bear bull ratio. Remember, this is delayed a little bit, where they were really getting fearful at the end of last week. As we saw those really strong up days, folks have been bailing out. And again, I understand this because you have jobs, you're busy, you're distracted. The stock market's not necessarily the center of your life. And so you might make your decisions. Well, a lot of times folks end up making the wrong decisions at exactly the wrong time. And that's kind of what's happening here. They were getting more fearful as after we had already gone down. So then they started getting out of that as we were shooting up. So it's just, yeah. All right. Then we had the latest reading of individual investors. They're still very, very pessimistic with things. And this is showing the margin. And I update this every week with the current market valuation charts. This shows how the margin has really come down and is starting to go back up slightly. But this could be an extreme negative reading. And this is actually, it might be a little more updated. We have it as of August with current market valuation. This was the low that we set down in an oversold level back in June. That's when we hit the lows. So when we start going back up, and if we're going in the right direction, people tend to want to enhance their returns, so they're more likely to buy on margin. And I have a whole section on margin that I go through my class, the nightmare. It's great when you're right. It can just wipe you out and destroy your life if you're wrong. So anyway, then I've been pointing this out as well. Last Wednesday and then Monday and Tuesday, we've had some really, really strong up days with explosive upward volume. Well, look at the times when we see other attempts at the market going higher after we see kind of a conglomeration here of upward thrusts. Well, these are a little bit further apart, and this one way over on the right, it's a little darker because it's taking into account Monday and Tuesday. Will that give the market some support? Because up here it says 290% up days in a row. on the 3rd and the 4th, that was Monday and Tuesday, have the potential to be bullish for stocks entering the best part of the presidential cycle. All right. So there's some historical tendencies that might be positive for the market, and we're seeing positive upthrust as well. This is just showing the S&P and the dollar as it's been changing. As the dollar's been going up, stocks have been coming down. And if you look at this over a period of time, it's nice to have a good, strong dollar, especially if you're living in another country or want to do some traveling. But it can really have either no impact within the US or actually work against you. And it really can hurt the earnings per share for stocks as well. So that's why it's been really not seen as all that positive with the dollar going up. Here, this is the cross asset correlations. This is how they've shifted after the COVID-19, all that. And this dark blue line here is the S&P over here. The light blue line is S&P with the Goldman Sachs. This is more of a international exposure right over here. And that's really been coming down, as well as bonds have also been coming down, but stocks have still been holding up fairly well. And then S&P with the dollar, or the Dixie. This is the other dollar index. I don't watch this one as much. I watch I use $USD to watch, just because I've watched that for so long, and their scales are different. And I just find it more comfortable to look at the other one. But this just compares how you compare the S&P when compared to other asset classes and their correlations to each other. Then the tightening in financial conditions points to further declines in activity. So here we have the financial conditions index. That's on the right-hand side. And of course, they have to invert it. And that's the light blue line, showing that things are weakening economically. And then we have current activity, which has been going back up. These have a tendency to move in the same direction, and we're seeing a rather disconnect right now, which may produce some more pressure on stocks. Another one, where are interest rates going to top out? That's called the terminal rate. When the Fed finally gets to its high point and stops and either keeps them there or starts bringing them down. Right now, they're saying it's at about 4.48%. And this changes all the time. Looking at the session where we saw value down a lot more than growth. So growth held up a little bit better with the large caps, not quite as good with the mid caps. Actually, they did hold up a little better. And small caps, we're seeing some hope in small caps. And you'll see that as I go through the charts. This could provide some support to the S&P. Our small cap to S&P ratio chart, it's looking a little better right now. So the VIX went up on a down day, so we closed higher. We're still at a pretty high level with the VIX, and we closed right about at the top of the bar since we closed pretty much near the bottom of prices. The VIX of the VIX with the down day is also turning back up after it had spiked and then was really starting to come down. It's kind of forming a base here on the bar chart, but it is advancing. And our Ulcer index starting to turn back up. It's picking up the last 2 days that were negative. We're down 22.29% from the all-time high, and see we're potentially building some kind of a base or another plateau. Are we going to be able to, after we came up to this level, are we going to shoot up out of that? Or are we going to fall down? Or are we going to continue to go sideways? The equity put call ratio declined just a little bit on the daily chart. After spiking on the 5-day chart, we are continuing to fall. This is a potential positive setup. Support and resistance, these are also posted on the YouTube channel in the community tab. This shows Friday's pivots. Here's the daily chart where we were slightly above the pivot. Well, now we've dropped right down below the pivot with the down day. You can see this blue line is the moving average, and we're right pretty much on top of that with volume. Okay, and then this is the other chart. They're good for the entire month of October. The different monthly pivot points that I also post each day on the YouTube community tab. Short-term fib levels, we're still seeing this as overhead resistance. If we go to the high that we set in early September, and then we really started to decline, this is when we hit the moving average and turned the other way. We came back down, we set what could be a low. Well, as we're trying to bounce up out of this, we're still seeing the 38.2% retracement level providing overhead resistance. And here we're kind of still in no man's land with this chart, but we also have other overhead resistance at current levels. So if we're going to go higher, we're going to need to see an increase in volume, a real conviction behind buying to break through some of these resistance levels. And we're still facing another overhead resistance level on the weekly chart as well. We're coming back up just a little bit below the midpoint right now with our trend channel. Sectors, 10 out of 11 were down, led by utilities. Utilities were the place to be just a few weeks ago, and they're just going down the toilet these days. The energy sector was the only sector that ended up being up, and a lot of that is probably due to OPEC, because there is the potential of being less supply on the market, which is amazing because just a couple of years ago, OPEC was becoming more and more irrelevant. And then our scooter score, we have a 99.4 for the energy sector, and now we have two sectors that are below 10. Communication at 7.4 and real estate, look at that, 2.5. Not looking good at all. And I don't think they have negative scores for these things. We'll have to see. So energy has been regaining a lot of what was lost and is still looking better. See how utilities have been really falling if you follow this every day, and all the other sectors continue to be negative. Here's the updated percentage changes since the all-time high a long time ago. Technical alerts started off with a couple that were positive, where the NASDAQ got above 11.2, only to fall below 11.1 later on. And we had a NASDAQ BPI cross above 30. That could be positive. Canada was having a little bit of trouble. That's TSX. The Dow dropped below 30, which, of course, that's what the financial media loves. I don't watch the financial media. I'm just guessing. I did for years and years watch them about 14 hours a day, and I found out that about 13 hours and 55 minutes of that was pretty much useless. I just look at charts overall, but they're probably making a big deal out of that. And real estate, which has really been getting hit lately, it set a new 52-week low. Mid caps continue to be in first place, even though they declined a little bit in their recent score, followed by the small caps, which are showing some improvement, and that could be encouraging. The Dow, even though it declined a bit, is in third place, with the S&P declining as well in fourth place, and the Qs were up just slightly, but they're in last place right now, technically. So here is the day and how it unfolded. We had a lower open. We saw some buying coming in, then some selling coming in. And then we finally dropped down below the pivot. Well, then we came back up to the pivot level, kind of danced along that, never could really get above that at any point, and then just drifted down and down and down going into the close. Our trend is weakening now. The ADX has dropped below the moving average. So you might want to look at the neutral side of things, or you might want to stick with the negative side of things, because the red line, even though it's declining, is still on top, and the green line is declining. Our rune is unchanged. And from the reading that we saw yesterday, breadth showing some weakness now. Here, these are the three really strong up days that I talked about earlier with the up thrust. But with the down day, we're seeing a decline based on price and volume, seeing a little bit of decline with the advanced decline ratio. New highs, new lows. We saw new lows kind of pick up a bit. So our 5 period is showing a little bit of trouble, but our 10 period still continues to move higher. Accumulation distribution, we're pretty much right on top of the moving average. Short term, yeah, we're looking at some overhead resistance right at the 20-day moving average. Either one of them, either the simple or exponential. Stochastic, still trying to work off an overbought condition. Williams percent are turning down, but still above the midpoint. Force index also starting to come back down a bit. With the Swindlen trading oscillator, it was pretty much sideways based on price and a little bit of an advance based on volume. That could be potentially positive. McClellan oscillator has dropped below zero, so that's negative. Our moving average study seeing a decline with the 20, 50, and 200. And stochastics turning back down with the short term, still getting better with the intermediate term and trying to come out from an extreme negative reading with the long term. Intermediate term, Sean trend meter showing some weakness and not necessarily extreme. The PMO, it's trying to turn up there. What we'll watch for is, does it cross based on price or volume? The volume one is just about ready to cross, and that could be positive. We're coming off of an extreme positive reading with those PMOs that were rising. We're showing some improvement with the buy signals and turning up with those PMOs that are positive. The Chaikin oscillator showing a little bit of weakness, but we're still above the midpoint. Chaikin money flow also showing some weakness. Seeing a little bit of a drop off the last couple of days in volume. The vortex declining based on selling, advancing based on buying, but the red line is still on top, so we are negative. The summation, it tried to turn back up based on price, but it's now going down. But volume is still hanging in there. This is another potential positive setup that we see. And with our oscillators, the slope is turned up, the MACD is turned up, the KST and tricks are trying to turn up. The PMO just maybe a day or so away from possibly having a crossover, and our TSI. So we're seeing a mixed picture right now, but an improving picture with our oscillators. But these tend to lag a while. The BPI, it actually went up slightly even with the down day. Ease of movement showing some improvement. The ultimate oscillator ticked down just a little bit after it had crossed above the midpoint. Money flow index is continuing to improve. Our TTM squeeze also showing some weakness right now with, or you could lean in the slightly improving category. Balance of power turned down a little bit and we're under the dashed line. This is still working off of a confirmed buy signal right now. Don't know if I would trust that or not, but that's what this chart generated earlier in the week. Our different charts still holding up okay with the hike in ASHI. We're still positive with the KEGI. And this is interesting. See how the Renko actually added an empty box on a down day. So it recalculated whatever it does to recalculate and actually looks a little more positive right now. And our 3-line break is still looking better. No change in the point and figure chart currently, and no signal either. We're back to neutral with the S&P 500 and the Elder Impulse system, as well as the SPY. We're still below with the SAR. That's positive. See this mixed picture we're getting here? We're in neutral, or kind of a, neutral purple land as far as the go, no-go system. Long term, we had been seeing some improvement with our 50, 150, and 200-day moving average study, but with the last couple of down days, they're turning back down. Our rate of change going back 200 periods, this is more the long-term oversold signal that I had been looking at. It takes longer for this to move, but it is trying to show some improvement. The special K actually looks like it might be flattening out a little bit here. And our diamonds are back to neutral. The Dow right on the pivot, just a little bit below. Can you see we're potentially at a tipping point ahead of the employment situation report? And the Qs have also switched back to neutral, and we're just slightly below the pivot point. The Vixen went up slightly on the down day and closed slightly higher. NASDAQ just a little bit below the pivot point. Mid-cap still above the pivot point. And remember, this is the best looking chart as of right now, even though they were down. And their chart is nothing to brag about, but it's holding up the best right now. The Wilshire is just a little bit below the pivot point. And I brought the Dow theory chart back because we've been seeing some improvement with the Dow, even though the last couple of days have been down. as well as the trannies. But look at the utilities, how they were just a week ago. They were like up here where my cursor's at and have just been going down something fierce. And now they went down and actually set a new 52-week low. The dollar, with stocks being down and interest rates being up, the dollar did bounce back up a little over 1%. And we're still seeing a pretty strong indication that the S&P 500 is going in the opposite direction of the dollar. Gold, yeah, here we go. This is it. This is the big one. Well, they were down. Silver also was up about 1/4%. But man, these bars that just kind of shoot all over the place. Oil is continuing to go back up. It's at 88.45. S&P to oil still having the tendency to go in the same direction. Bonds were down a little bit, a little over 1/3%. And our world bond index was actually up a little over 0.5%. The stock to bond correlation, even though it's getting a little bit weaker, they are having a tendency to go in the same direction. Our yield curves, no changes here. We have the 10 to the 5 inverted, the 10 to the 2 inverted, the 30 to the 5 inverted, and we're still wondering if the 10 to the 3 month will ever go inverted. Tech to the 10-year, getting back almost to a neutral reading right now. Yields actually went up across the board, and still the blue line's on top, and that's the 2-year yield. Just amazing. Yes, we are inverted. Our scenarios, little bit of weakness with our 19-day exponential moving average. We're working off of this extreme negative spike, which sometimes gives some support to the S&P, both based on price and volume. The percent of stocks above their 200-day moving average declines slightly. But again, when we go extreme, this can often provide support to the S&P. But we've seen this before. The 50-period study also, when extreme, could give some support. Looking at the mid caps, the same thing, and the small caps. So we've got these setups that are in play right now. We just need to see follow through with price. 10-day average of the highs and lows coming up just a little bit right now after giving an extreme negative reading. And if you look at where we had these negative spikes, what happened to the S&P afterwards tends to be positive. Broad market, the highs minus the lows over a 5-day period, still more negative, but we did get pretty extreme. The equity put call ratio over 5 periods continues to come down after giving us this spike. And again, these spikes often mark some kind of a low in the S&P. Will that happen this time? Small caps are still above the pivot, and we're down less than the S&P, so the ratio improved slightly. And so we're seeing just a little bit of a tick up here. We want to see a noticeable tick here. Now, we don't want to use a magnifying glass to see this, but if we can see small caps really start to go up, that could provide more support to the S&P. The S&P to the 10-year working back more towards neutral, but still having a tendency to go in the opposite direction. Our sectors, a little bit of an improvement with the Qs, but still below the moving average. Pretty much sideways with discretionary and large cap growth against large cap value, showing a little bit of improvement. And the one that's kind of looking a little better is the small caps. The small cap growth to value ratio is showing some improvement. Little bit of an improvement with the mid caps. We're not seeing it follow through to the large caps yet. The S&P to the 2-year also working more towards the neutral area, but still having a tendency to go in the opposite direction. We don't know. We're going up again and possibly setting a new spike here. This is another potential positive thing. We're seeing the S&P utilities ratio. The S&P is really starting to perform better than utilities, and that could be positive. Again, if you compare when we hit a low in this, what happened to the S&P afterwards? Also, when we hit a high, what happened to the S&P afterwards? So there's some real positive things in the background that could really shoot us up, but we've got all these headwinds that we're dealing with at the same time, and we need to see follow through with price, which just hasn't happened over the last 2 days. Staples were down 1.5%. And so this does look like a valid spike, and we are coming back down. So that also could provide some support to the S&P. Then this crazy scenario that I came up with that's really not working out all that well, but I was thinking after the two big strong up days, okay, what if we have a short-term pullback that's not all that much, which would be right about where we're at now. And then some of the charts that were getting ready to give us signals, maybe they would give us some signals and help provide support to the market. The first one was a mass index. Well, this has been going down, and it never did generate a signal by going above the blue line. That's signal part one. So it did generate part two, but it's going to have, you can't really have a real convicted part two without having a part one. This is another one that we're crossing above the Copic curve after setting some kind of a low. This could be a signal that might suggest that something is going to happen and likely to the upside. There's another new one. Haven't shown this one in a while. The Pring Bottom Fisher. And this does pick direction. That's how it got its name. We had a really extreme negative reading here, but it's starting to turn back up. Could that point to giving the S&P some kind of upward thrust potential? Our outlook for Friday. Technicals are negative, and see how we're kind of mixed in some areas. We do have some positive setups, but yet most of our charts are still negative at the same time. We have the employment situation report. That's the most important one, and that's considered to be, well, CPI is kind of the real big one these days, but this is also very important. We have wholesale inventories and consumer credit. They'll come out later in the day, not as important. The whole list of geopolitical events with the Russia-Ukraine situation, any more Fed speak that we may get, things going on in the UK, the Nord Stream pipeline, yeah, the usual stuff that's lately been happening. So our scenarios, we still have to go with the down scenarios, but the technicals are mixed, and we're not that far out of being oversold in some areas. So it's really hard to justify going down. We can't really go with the up scenario because we haven't really seen a follow through in price, and we're seeing some mixed signals. You might be able to go, if you're more aggressive with the ADX, saying that, okay, maybe we're in a more neutral environment. I can implement some more neutral strategies these days, but we might not stay that way for very long because the ADX is weakening and going below the moving average, but it's still above 20 and the red line is still on top. So you'd want to lean more towards the negative side of things. At least that's what I would do. So our conclusion, and I changed it back to the S&P 500, it's negative with some possible positive setups that are happening. Short term, negative, slightly mixed. Intermediate term could be improving. Long term, we're still pretty much negative overall. So thank you. Have a wonderful Friday. And as I said, I'll prepare the videos as I can over the weekend, the daily video, the weekly video, and the intermarket analysis video.